Hello options traders, welcome back everyone. And I know what you're thinking already. This has got to be a misprint. The advantage of options expiring worthless, who ever heard of such a thing? Well, it's actually right. As you learn about the art and science of options trading, you're going to find out that when an option expires worthless, it's doing exactly what it was designed to do, and it's actually an advantage. It's a little difficult to see, and really we could do the presentation with either calls or puts. Just for simplicity, I'm going to do it for calls. But whatever we can do with a call option, you can do with a put. So the argument applies for both. But let's take a look at the advantage when options expire worthless. So to recap the danger here, a lot of times new traders or stock traders will say if an option expires out of the money, you lose 100% of your investment. However, if you purchase the shares, you can always hold on forever, waiting for that price to come back, because in most cases it usually does. But if your option's expired, you're done. You've lost everything. But you can always choose to hold on to the shares, and therefore you're better off. That's their argument. It's not true, but that's the way they see it. Because again, an option expiring worthless is actually an advantage. So to see why, in the last video entitled The Mathematical Borrowing Advantage of Options, I talked about when you buy a call option, you're actually floating the cost. And I said that call buyers have the right to exercise. It's not a requirement, it's a right. So if you buy a 1-year $100 call option, for example, you are floating that $100 payment. You don't pay that today. So if it's a 1-year option, you could choose to wait for a full year, then exercise, and then pay that $100 strike price. So you are, in a sense, borrowing that money. And that's where one of the many advantages comes from. So now to see why it applies for a call option expiring worthless, let's take a look at two traders. Let's say that we have Trader Joe here, buys 100 shares of Home Depot, going into the close on Friday, trading at $192.34. And we have a second trader here, Trader Jane, who buys the May 165 call, had 82 days to expiration at that time, trading for $27.82. Now, of that $27.82, $27.34 is intrinsic value, and the remaining 48 cents is extrinsic value or time value. And the reason I chose this 165 strike was to really give kind of an extreme example, using a lot of intrinsic value and only a tiny bit of extrinsic value. But take a look at what's happening here. By purchasing this option that has 48 cents of extrinsic value, that is mathematically the same thing as paying 48 cents for a put. Because in that last video, I said that a call option was mathematically the same thing as long shares of stock plus a put plus a short bond. The short bond comes from borrowing, in this case, the 165 strike. But the stock plus put is your insured shares of stock. So mathematically, we could do the same thing by purchasing the shares of stock and buying a put option, which theoretically would be trading for 48 cents as well. It's exactly the same thing. The difference is the stock trader has to go out and actually shell out the additional 165 today. The call option trader gets to float that. So for right now, what I want you to see is that of this $27.82 that Jane spends, 48 cents of that is over and above the intrinsic value. And that's really what she's spending for the insurance policy. So why is the insurance policy so cheap? Because the stock's trading above 192. And the chances that it falls below 165 in the next 82 days is pretty slim. And if the chances are pretty slim, the insurance policy is pretty cheap. So let's take a look at a couple of scenarios. Let's say that Home Depot rises to 200. Well, Trader Joe earns, we take his $200 selling price divided by the $192.34 purchase price, subtract off 1, convert it to a percentage, and he's going to get about 4%, just a touch less. But if that stock is trading for $200 at expiration, that 165 call is trading for exactly $35 of intrinsic value. So that means that Trader Jane earns $35, that's the price she could receive in the market, divided by her $27.82 purchase price, subtract off 1, it's going to get 26%. And so the reason she's getting this big magnification in the return is because she paid so much less to control the same 100 shares. Well, this is the obvious advantage. This is what everybody shows. They say, well, you buy the call option, it goes up, you get this advantage. But the argument that the stock traders make is they say, okay, well, hold on a second. What if Home Depot falls, let's say, to 150, comes crashing down? What happens now? Well, Trader Joe loses. Let's say he sells it for 150, divided by his 192.34 purchase price, subtract off 1, he's going to lose about 22%. And if the stock is 150, that 165 call is worthless. And that means that Trader Jane loses 100% of what she paid. And this is where Trader Joe will point the finger and say, see, the option has a huge danger. Jane, you lost 100%. I can still hold on. I still have my investment, which will eventually come back. But that's not true. Take a look at why. Jane could exercise her call and spend the 165 strike. Just because it's worthless doesn't mean she's not allowed to exercise. She is always allowed to exercise. So if she did that, her cost basis would be the 165 strike plus her 27.82 purchase price, or 192.82. Now Trader Joe's was 192.34, just 48 cents lower. Why did Jane spend 48 cents more for her shares? Because she paid 48 cents for the insurance policy. So she's basically in the same boat as Joe, just off by 48 cents. But hopefully you're saying, well, hold on a second. If the stock is trading for 150, it would be flat out stupid for Jane to exercise and pay 165. And you're exactly right. In other words, it's to her advantage to let the call expire worthless. So here's what would happen. With the call expiring worthless, she could go out into the open market and buy them for 150. She has also still purchased that call option, so her effective cost basis would be 150 plus the 27.82, or 177.82. Well, remember that Trader Joe's cost basis was 192.34. So Jane is now better off by $14.52 compared to Joe. How did that happen? Well, her 165 put that she purchased, remember she bought a call, but mathematically it was the same thing as buying stock plus a put. So if she bought a 165 put mathematically and the stock is now at 150, the put is worth $15 of intrinsic value. And because she paid 48 cents for that, she's better off by $14.52. So by letting the call option expire worthless, Jane took full advantage of the embedded put option inside that call. Now, if that sounds a little odd to you, then you definitely need to understand the art and science of options trading. And for those who'd like to learn more, please check out the Alpha Trader course and Strategy Lab at optionsaToZ.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.